The financing decision connects three separate parts of the business plan. The investment plan sets out the amount of additional assets that must be purchased. The income statement and the dividend payment plan sets out the amount of earnings that are available to be reinvested in the company. If we are committed to returning 60% of earnings back to equity investors as dividends, then only 40% of earnings are available to be reinvested in the company. The financing plan will provide our targeted capital structure, the mix of equity and debt and how it is raised, which limits the growth in assets. For example, if the financing plan says the company will not raise any external funds, then the increase in assets is limited by the amount of earnings retained. If the addition to retained earnings is not sufficient to pay for the planned purchase of assets, then the company will either have to reduce its asset purchases or alternatively reduce their dividend payments in order to reinvest more in the company. If there is a restriction on how funds are raised, then there will be a limit on how fast assets can grow, which will limit how fast sales can grow. We can take an assumption about the capital structure and use that to forecast the growth rate of sales. Here are two equations that do that for two different assumptions about the capital structure. The internal growth rate assumes that the company only uses retained earnings to finance new assets. If that is the case, then the rate of growth for the company in terms of assets will equal the addition to retained earnings divided by assets. Another way to express that is that the internal growth rate equals the plowback ratio, the fraction of earnings that is reinvested in the company, multiplied by the return on equity, which tells us the amount of earnings generated per dollar of assets, and this multiplied by equity over assets, which measures how important equity is a source of financing. From this equation, we can see that the more profitable the company is, or the more it reinvests in itself, the faster it will grow. A similar measure is the sustainable growth rate. Like the internal growth rate, it assumes that all equity investment comes from retained earnings. But unlike the internal growth rate, it assumes that we increase debt proportionately with equity, so that the debt-to-equity ratio remains constant. Because of this, the sustainable growth rate will be higher than the internal growth rate for any company using debt. We can walk through a simple example. Imagine that the plowback ratio is 1. All earnings are reinvested in the company, and earnings are 30% of equity. If we reinvest all those earnings back into equity, then equity will grow at 30%. Debt will also have to grow at 30% to keep the debt-to-equity ratio constant. Since both equity and debt are growing at 30%, then assets will grow at 30% as well. If we reduce the plowback ratio by paying more dividends to investors, then less money will be added to equity, and debt and assets will all grow more slowly. There are sophisticated models that combine the various modifications we've talked about here. They may make separate forecasts for sales and for items that are not expected to grow proportionately to sales. Other items, that is, things that are not sales, may get their own forecasts, perhaps from the investment plan. A financing plan will lay out how the money is raised and the effect on the capital structure. The results of the financing plan may constrain the investment plan, which will affect the sales forecast, and so management will often have to revise the various assumptions until all plans agree. We can see how the various parts of the business plan interact by looking at the connections between balance sheet items and income statement items. For example, if debt increases on the balance sheet, then this will increase interest costs on the income statement, which will reduce the addition to retained earnings on the income statement, which will reduce the increase in equity on the balance sheet, which will reduce the increase in assets on the balance sheet, which will reduce the increase in earnings on the income statement. A few final comments on forecasting. Generally, college classes, including this one, present forecasting as a very mechanistic activity. Put a bunch of numbers in a spreadsheet and use some simple formulas to forecast the future. In practice, there's much more judgment involved. Don't let Excel be a substitute for your brain. When forecasting, you need to ask yourself if the numbers being produced seem reasonable, particularly with respect to sales, since it's often the primary driver of the forecast. One way to do this is to have a story for how consumers and competitor firms must behave for the forecast to come true, and then question whether this behavior seems reasonable. Since forecasts include a number of different assumptions, it's important to perform sensitivity analysis, which involves changing the assumptions to see how the forecast changes. For example, assume that sales grow more slowly than expected, and see if that puts stress on the company's cash position. We'll discuss sensitivity analysis in more detail in the section of the course on capital budgeting.